7 Reasons Why Private Equity Fails. Some sessions ago, we discussed the private equity fund and its structure. We also discussed the advantages you can obtain, such as more significant returns compared to other markets. Well, private equity definitely has its downside as well. If you probably have not seen the other video, I will quickly go through private equity in general, so that as we progress, you get a better understanding of the discussion. So, private equity is simply raising money or capital and investing in companies to improve their performance and gain off from their productivity. We have the two leading investment players known as the general partner and limited partners. The general partner, who is the governing body, comes up with an idea of, say, investing in agricultural produce. He is the governing body and therefore is responsible for seeking out other investors who are known as limited partners, accrues the investments they make, known as the fund, and then invests it into the business of agricultural produce. The general partner has unlimited liability, unlike the limited partner, who has limited liabilities. Total liability simply means that the general partner is at risk of losing other assets he may not have invested into the fund. For limited liability, however, the partners only risk losing capital they invested in the fund. In today's video, we will be talking about some reasons why, despite private equity being relatively advantageous, it sometimes still fails to deliver the necessary output. Before we get into the reasons, remember to hit the subscribe button and like the video. Now, let's get started. Number 1. Insufficient funding. The entire aim for a private equity fund is to invest capital and obtain a maximum profit over a period of time. Usually, the amount acquired to be invested to some extent affects how much profit you can make within the stipulated time. So, if the partners are unable to raise sufficient capital for the business in question, the equity may fail to secure ownership and reach its supposed target. If, per calculation, a $24 million deal is expected to harvest an 8% profit within a period of 10 years, a lesser invested capital will make fewer profits. Number 2. Wrong decisions. There are certain very technical decisions to make in private equity by both the general partner and limited partners, like what type of business to allocate funds to and how many returns you expect to make. The thing is, bad decisions could be made and can totally affect the expected outcome. For private equity also, note that very large funds are invested because more often than not, large companies or upcoming businesses who need capital are invested into. Without careful analysis and proper decision-making, more losses could be incurred instead. Number 3. Violation of charter. A charter is a relatively expensive book containing all documents drafted and outlined by the general manager concerning the private equity investment procedures and rules, which is approved by the limited partners as well. The charter gives the GP autonomy over the investment as it is written by him. It indicates the responsibilities of both the general partner and the limited partners. Violation of the rules affect the organization and downplay the essence and power of the general partner. For instance, it will be a total violation for a limited partner to request returns or capital funds when it is not yet stipulated withdrawal period. This could affect the organization and credibility of the equity. Number 4. No experience in investment banking. According to Wikipedia, a financial service company or corporate division that engages in advisory-based financial transactions on behalf of its individuals, corporations, and government is an investment bank. In effect, the investment bank provides consultation services on how to raise funds. Little or no experience in investment banking as a firm could make it relatively difficult to come up with effective strategies to issue stocks and make the necessary deductions on areas you need to invest in to obtain maximum interests. In the previous session, I spoke about private equities having what we call a registered investment advisor who counsels partners on areas to invest in for significant benefit and the format for the organization in general. Number 5. Insufficient research. Not having much information on something always costs, right? The same applies to private equity. One important thing to do before starting a private equity fund, and even when you already have a private equity fund, is to make your research on its operations in a very detailed manner, as well as finding the relevant information on companies and institutions that you invest your fund into. You need to know the daily operations of the institution you as a firm seek to invest in, and how they are possibly going to work with the invested capital to bring the equity the needed returns. Thorough research always prevents bad decisions in an outcome. you have managed to come this far, remember to subscribe to our channel and like the video as we proceed to the last 2 reasons why private equity fails. Number 6. Cost-cutting services. This may not be a significant reason, but it is definitely one of the contributing factors to the failure of a private equity. When private equity engages in buyouts of a public company, it is termed delisting. This means public shares will no longer be available on public stock exchange platform. When this happens, some private equity firms lay off certain workers to cut down the cost of services and invest the money in other areas. Doing this will deprive the equity of certain skills from workers they could have obtained in the pushing and development of the company to make significant returns. Number 7. Not targeting the right investor and investment group. This is similar to making wrong decisions. As a private equity, you need to target the right people to solicit for capital to form the fund and target the right businesses to invest the fund into. As you already know, it saves you time, trouble, and possible debts you could make. I've come to the end of another beautiful session spent with you. Remember to keep these 7 points in your head if you decide to start an equity fund or invest in one. Some prominent names in the equity space include Blackstone Group, Partners KKR, Carlyle Group, etc. You can read or research on them to find out more information on private equity and some of the avoidable mistakes you can make. I wish to come your way next time. Remember, if you have not subscribed to this channel, do so, and like the video as well as leave a comment so I know what you think. Till we meet again, bye!